So, financial accounting. Today we're gonna start chapter 21. That is relating to consolidated statement of financial position. We have discussed already how to prepare statement of financial position. How to prepare statement of financial position. We record non-current assets first, then we record current assets, we total them, then we record equities, then non-current liabilities, then current liabilities, and these two totals should be matched. We have learned how to prepare statement of financial position. Today, we are going to learn how to prepare consolidated statement of financial position. What is meant by consolidated? Suppose there is a company A and another company, company B. If this company A has acquired company B, mean purchased company B by more than 50% holding, mean company A have bought more than 50% shares of company B. In that case, company A will be called parent company or called holding company, and company B will be called subsidiary of company A. So if company A has bought more than 50% holding, more than 50% shares of another company, in that case, the investor company will be called parent company, mean holding company, and the investee company will be called subsidiary. And in that case, the parent company, if A has or any other company has become a parent company, mean he is having its subsidiaries, they need to prepare consolidated financial statements. What is meant by consolidated financial statements? They need to consolidate the financial statements of their subsidiaries into their financial statement results. Mean what are the consolidated financial statements? The results of company A mean parent company and results of company B mean subsidiary. They will be consolidated. They will be combined to prepare consolidated financial statements, mean non-current assets of parent company and subsidiary company should be added. Current assets of parent company and subsidiary company should be added. Equity of parent company plus subsidiary company should be added. Non-current liabilities should be added and current liabilities should be added, and the total figure by adding results of parent company and subsidiary will be called consolidated results. Can you understand this concept? When we need to prepare consolidated financial statements? When a company has bought an other company either completely or more than 50%. If less than 50%, it will not be called subsidiary. Then you don't need to consolidate their results to year. Then you don't need to prepare consolidated financial statements. There could be more than one subsidiary. Suppose company A has bought 50% of, say 60% of company B, and they have bought 80% of company C. Then all three company results should be consolidated into consolidated statement of financial position. So who is the parent company? Who is investor? Who is subsidiary? Investee company. Investee mean whose share has been bought by other company. How to prepare consolidated financial statements? Mean what matters we need to consider while preparing consolidated financial statements. First, he has explained what is a group. Group mean parent subsidiaries. This is called group. Mean companies in a group should prepare consolidated financial statements. If A has bought 60% shares of B, 80% shares of C, all three companies will be called group companies. So group exists where one entity, the parent, referred to as the investor, has control over another entity, the subsidiary referred to as investee. And in accordance with IFRS and consolidated financial statements specify three criteria that must apply if one entity is to have control over another as follows. Mean for subsidiary, these three criteria should be fulfilled. Number one, power over the investee, which is normally exercised through the majority of voting rights, i.e. owning more than 50%. If 50 are less than 50, then there will be no majority. In your holding should be majority. Majority mean more than 50% voting rights, more than 50% shareholding. Exposure or right to variable return from involvement, for example, a dividend mean you can decide the dividend payments because you are the majority investor. And the ability to use power over the investee to affect the amount of investor return. This is regarded as a crucial detriment in deciding whether or not control is exercised and you are having a control over that company. Obviously, if you are having a major shareholder, you will be having a control. Who is a parent? A parent is an entity that controls one or more entities. And who is subsidiary? A subsidiary is an entity that is controlled by an other entity, mean parent company. So now we're gonna discuss how to prepare consolidated financial statements. How to prepare consolidated financial statements. Let's see, this is the financial statements. These are the results of holding a company. Holding company mean parent company, and these are the results of subsidiary. How we will prepare consolidated financial statements for non-current assets? What we will do, we will add them. While preparing consolidated financial statements, we will add them. In holding company, if you see, there is an investment of shares in a C. Investment of shares in a C. What is this? Mean holding company have bought shares of subsidiary company for 60,000. So holding company will show in his book. Like this is his investment in subsidiary. Mean they bought subsidiary shares in 60,000. And then current assets, for current assets, we need to add them. To prepare consolidated financial statements, we will add them. Current liabilities, we will add them. Now look at equity part. What we need to do with equity. These four things we need to check in preparing consolidated financial statements. One, investment. Second, share capital, share premium, and retained earnings. For share capital and share premium, we don't need to include these. While preparing consolidated financial statements, we will just use the parent company share capital and share premium. We do need to do anything regarding share capital and share premium in consolidated financial statements. Mean property, plant and equipment, suppose this has been added to this amount, we will calculate in consolidated financial statements. Statement of profit, statement of financial position. Regarding this investment, we will write another account balance called goodwill. How to calculate that goodwill, we will discuss later on. Current assets, we will add and record the figure. For equity share, we will record only parent company like 65,000. For share premium, we will record only parent company like 35,000. For retained earning, we need to calculate the figure. For retained earning, we need to calculate the figure. How we gonna discuss? For current liabilities, we will add and record. And then we will make sure these total agree with each other or not. So let's discuss how we can calculate goodwill. How we can calculate goodwill. The calculation of goodwill is based on a formula. Goodwill. Fair value of consideration paid. How to calculate goodwill? Fair value of consideration paid less fair value of net assets acquired. Fair value of consideration paid and fair value of net assets acquired. This amount will be given in the question. And this amount we need to calculate. What does that mean? Suppose Virat Kohli is using a bat. The value of that bat is say 10,000. Because that bat has been used by Virat Kohli in the World Cup. So we bought the value in selling price of that value. We bought that bat for 100,000. The value of that bat is 10,000. But as it is used by Virat Kohli in the World Cup, so we bought that for 100,000. This 100,000 will be called consideration paid. What we have paid to buy that company or buy that asset. This 10,000 is the fair value of net assets acquired. So what is the difference? 90,000 that we have 90%. Paid over the fair value, that will be called goodwill. I mean, whatever amount you have paid over the assets to buy that company, that will be called goodwill. How this will be calculated? Consideration paid, mean amount paid, less fair value of net assets acquired. Consideration paid will always be given in the question. This we need to calculate. How to calculate, we're gonna learn later on. Can you understand this? How to calculate fair value of net assets acquired, we will discuss later on. Is that fine?
Oh, yes, sir.
So how to calculate goodwill? Fair value of consideration paid, mean amount paid to buy the company, less fair value of net assets acquired. How to calculate this, we're gonna discuss. Suppose in this question, if we see, we bought subsidiary S. How to calculate net assets? So we are moving towards calculation of net assets. We need to calculate two types of net assets. One, can I abbreviate through NA? Net assets at the time of acquisition. Acquisition means when we are buying that company, and we need to calculate net assets at reporting date. Reporting date means year end. These are the at reporting date. And these are the year end figures of subsidiary. This means these are the at reporting date figures for share capital, share premium, and third figure is for retained earning. First one is for share capital, share premium, and retained earning. And what are these figures? 20,000, 10,000, and 25,000. 20,000, 10,000 plus 25,000. These two figures will always remain same at the time of acquisition and at reporting date. In consolidation, what we will assume, the share capital and share premium of a subsidiary will remain same at the time of acquisition, mean when we bought the company, and at the year end, these two figures will remain same. This figure retained earning we will find in the question. Like in this question, if we see, H acquired 100% holding of S on 1st January 20x8. At that date, S subsidiaries retained earning were 15,000. At what date? When they acquire, mean at acquisition date, what are the retained earnings? 15,000. So the total of these three will be called net assets. How much at the acquisition date? 20, 30 plus 45,000. How much at reporting date? 20 plus 10, 30 plus 25, 55,000. So why there is a difference? How much is the difference? 10,000. This 10,000 is a profit earned during the year. So how to calculate net assets? These are the net assets at acquisition date. These are the net assets at reporting date. Here in goodwill, what we need consideration paid. If you read the question, there will be consideration paid. Consideration paid. How we can calculate consideration paid? See, in order to illustrate the basic principles involved in consolidation statement of financial position, we will use H group blah 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 blah. This is consideration paid, mean how much is the investment? 60,000. So 60,000 is your consideration paid. And what is the fair value of net assets acquired? Fair value of net assets acquired is at the time of acquisition, fair value of net assets, that is 45,000. So what could be the goodwill? 15,000 is the goodwill in this question. Consideration paid mean the investment of shares in S. So while preparing consolidated financial statements, what we will do, we will mention property, plant and equipment by adding these two figures. Instead of this, we will show goodwill of how much amount, whatever we have calculated through formula, fair value of consideration paid less a fair value of net assets acquired. How we can calculate net assets acquired? Share capital plus share premium plus retained earning at the time of acquisition. This will be either provided in question or we need to calculate this. If it is provided in question, simple, add them these three, we will be having fair value of net assets acquired. Is that fine? So in
Yes, sir.
consolidation, everything will be added except this investment in S. Instead of this, we will calculate goodwill and record it. For share capital, we will record only parent company share capital. For share premium, we will record only subsidiary share premium. And retained earning, how to calculate retained earning, we're gonna discuss now. How to record retained earning, we're gonna discuss now. And for current liabilities, we will add them. Suppose we are preparing consolidated financial statements here. So for property, plant and equipment, PPE, we will record 85 plus 18. How much is that? 103,000.
103.
And then we will record goodwill. How much goodwill we have calculated? 15,000. Current assets, we will add them 160 plus 84 to 44 to 24 to 44,000. So this will be our total assets. How much is that? 103 plus 15,
So it will
118.
be, yes, sir. And 18 plus 44 to 44.
What will be the total? 9
Sir,
plus 3, 2, 4, 5, and 6, and 362,000.
yes, sir. 362.
And then share capital, we need to record only for parent company, that is 65,000. Share premium, we need to record only for parent company, that is 35,000. And for retained earning, we need to calculate, we need to add the retained earning of a parent company, this figure, plus the share of subsidiary, plus the share of subsidiary. How we can calculate retained earning? Holding retained earning. How much is the holding retained earning? 70,000 plus share of subsidiary. How much subsidiary has earned profit during the year? 10,000. How much they have earned? 10,000. How much is your investment in subsidiary? If it is 80%, we will take 80% of this 10,000. If it is 100%, we will take complete 100%. So this will remain 10,000. How much will be the total? 80,000. So 80,000 will be recorded here. And then we need to add the current liabilities. How much? 135 plus 47. How much is this? 7 plus 5, 2. 4 plus 3, 7, 8. 182,000. Can you add and check whether it's 362,000?
Uh, yes, sir.
Yes, 362,000.
Yes, sir. It's 362,000.
So we have learned how to prepare consolidated financial statements. Instead of this investment, we will record goodwill by calculating how to calculate goodwill. Consideration paid, that will be given in the question, less a fair value of net assets acquired, that we will calculate by using this. Share capital of subsidiary, share premium of subsidiary, and retained earning of subsidiary. And these figure will be given for the reporting date, but these two will remain same for this. At the time of acquisition retained earning, this will be given in the question, or we need to calculate. By totaling these, we will be having a total of net assets, fair value net assets, that this total will be used in goodwill. In how much asset we have acquired at the time of acquisition, we need to know the value of assets. And the difference between retained earning will be the current year profit. And to calculate retained earning, what we will do, holding company retained earning plus share of subsidiary retained earning means subsidiary profit. The subsidiary profit is 10,000. If holding is 100%, we will take 100%. If holding is 70%, we will take 70% of this. Is that fine?
Oh, yes, sir.
Okay, now moving forward. Suppose Suppose if we bought the subsidiary not 100%, less than 100%, in that case, what will happen? If we bought the subsidiary not 100%, mean less than 100%, in that case, what will happen? How to calculate goodwill in that case? Suppose we bought the subsidiary shares 80%. What we will do? We will calculate net assets of subsidiary first, share capital, share premium. Forget about revaluation surplus now. Retained earning, total, share capital, share premium will remain the same. And the opening figure of retained earning, we will see whether it is given in question. So we will add. So this is the fair value of net assets acquired. What was the formula? Consideration paid less fair value of net assets acquired. But if we bought the subsidiary less than 100%, in that case, consideration paid that will be given in the question like investment in subsidiary. We will add non-controlling interest at acquisition. What we will add? Non-controlling interest at acquisition. What is that non-controlling interest at acquisition? What is that non-controlling interest at acquisition? Suppose in the similar question, the previous question, if we see the share capital was 20,000, share premium was 10,000, and retained earning at the time of acquisition was 15,000. This is net assets at the time of acquisition and net assets at the reporting date. Thus, this figure will remain same. This figure will remain same. And this was 25,000 over there. These were total 45,000 and these were total 55,000. And the consideration paid was 60,000. But we bought 80% of the subsidiary. Now we bought 80% of the subsidiary. This means 20% is the interest of others. 20% is the interest of others, not your. You
Oh,
are
yes, sir.
having 80% interest, 80% holding, 20% holding is of other investors. How much holding is for other investors? That will be called non-controlling interest, mean that is not in your control. So we need to add that figure as well, and this will also be given in question. Suppose this is 10,000. This total will become 70,000. This will be called consideration. Now we need to deduct fair value of net assets acquired. How much are the net assets acquired? 45,000. So what will be the goodwill here? 70 minus 45, 25,000. But in case your holding is less than 100%, how to calculate goodwill? Consideration paid plus non-controlling interest, NCI, non-controlling interest, that will be given in the question. This will be given in the question. And fair value of net assets acquired, we will calculate by using this. These are the results of subsidiary only. We don't need to include parent company results here. These figure will be given in the question, balance sheet. This will remain the same, so we will copy them, and this will be given in the question separately. So in case your holding is 100%, how to calculate goodwill? Consideration paid less a fair value of net assets acquired, only two figures. But in case your holding is less than 100%, in that case, consideration paid plus non-controlling interest that will be given in the question, and we need to subtract what? Fair value of net assets acquired. Is that fine?
Oh, yes, sir.
Okay. Now, how to calculate retained earning figures? How we had calculated holding retained earning? In that question, that was 70,000 plus subsidiary share. How much is the profit for the year? 10,000. Now we will not include complete 10,000. We will calculate 80% of this 10,000. How much is 80%?
8,000.
8,000. So now the retained earning for consolidated financial statements will be 78,000. For consolidated financial statements, this will be goodwill, and this 78,000 will be called retained earnings. How much the profit? 10,000. Out of this 10,000, 8,000 we have recorded in retained earning. The remaining 2,000 we will record as non-controlling interest, where under liabilities in the consolidated financial statements. If your holding is 100%, what we will do? 70,000 plus 10,000, 80,000 will be recorded retained earning. There will be no non-controlling interest because you hold 100%. There is no other holding of other people. But if your holding is less than 100%, in that case, you need to consider non-controlling interest in calculation of goodwill, and you need to show non-controlling interest profit out of year profit as liabilities. Can you understand this?
Oh, yes, sir.
Okay. So non-controlling interest. How to calculate non-controlling interest? Fair value of non-controlling interest given in the question. Plus we will add this 2,000, then we will calculate non-controlling interest figure that should be presented under consolidated financial statements in liabilities. And group retained earning, parent company retained earning plus subsidiary share, means subsidiaries profit share. In these three figures has been shown how to calculate goodwill in case your holding is less than 100%. How to calculate non-controlling interest? Under non-controlling interest, we will need to show this 2,000 plus this 10,000 as well. That will be given in the question. So 12,000 we will show non-controlling interest under liabilities in balance sheet. So we have covered illustration 1. Now moving towards illustration 2. It is there. Yes, station 2. So the statement of financial position of D and J. D is a holding company, J is a subsidiary. In D is a parent company, J is its subsidiary. Property, plant and equipment, we will simply add them. Investment in shares, instead of this figure, we will record goodwill. Current assets, we will add them. And for share capital, we will record only subsidiary, parent company share premium, we will record only parent company, and retained earning, we need to calculate adding into this the profit share of subsidiary. And for current assets, we will simply add them. D acquired 80% holding in J on 1st January 20x8. At that date, J's retained earnings stood 20,000. Mean these are the reporting date retained earnings. These are the retained earning at acquisition. On this date, the fair value of 20% non-controlling shareholding is 12,500. In non-controlling interest, fair value is also given. Calculate goodwill arising on acquisition of J. How to calculate goodwill? Consideration paid. What is consideration paid? What is consideration paid? The investment given in the question. At fair value of non-controlling interest, what is that given in the question? 12,500 less fair value of net assets acquired that we need to calculate. How to calculate net assets acquired? We need to make two columns. Net assets at the time of acquisition and net assets at reporting date. Share capital, share premium, retained earnings. Share capital figure is given 20,000, 10,000. So 20,000 at reporting date, 10,000 at reporting date, retained earnings at reporting date, 25,000 given. So these will remain the same. And at the time of acquisition, what is the value of retained earning? It's given in the question. How much is that? 20,000. So fair value of net assets acquired will be 50,000, while reporting will be 55,000. How much profit we have generated during the year of 5,000. And out of this, 80% is R, 20% is of non-controlling interest. So what is the fair value of net assets acquired? 50,000. What is the amount of goodwill? 72,500 minus 50,000. 22,500. Is that fine? If we prepare consolidated financial statements, so these will be added together 103,000. Instead of this, there will be goodwill of 22,500. Current assets will be added together to 44,000, and this total will be 369,500. Is that fine? 369,500. Share capital, we will record only parent company. How much?
Yes, sir.
65,000. Share premium, we will record only parent company. How much? 350,000. Retained earning we need to calculate now. How to calculate parent retained earning? How much? 70,000. And subsidiary profit share. How much is the subsidiary profit? 5,000. 80% is your share. That will be 4,000. So altogether 74,000 will be retained earning. but we need to record non-controlling interest. How to calculate non-controlling interest? Fair value of non-controlling interest that is given in the question. How much? 12,500. And subsidiary share. How much is subsidiary profit? 5,000. What is their share? 20%. How much is 20%? 1,000. So what's 13,500? So this will be 13,500, and current assets we will, current liabilities we will add 135 plus 47. How much is this?
135 plus 47 will be so 182.
182. Now please check, is that 369,500 total?
Sir, 103 plus 22. Oh, 7,
Just check
so
whether this total
369.
is 369,500.
Yes, sir. Yes, sir.
So we have covered how to prepare consolidated financial statements if your holding is 100%, and how to calculate consolidated financial statements if your holding is less than 100%. Three things we need to calculate. In fact, four things we need to calculate. First, we need to calculate net assets using the results of subsidiary, share capital, share premium, and retained earnings. Because through this, we can calculate goodwill. How to calculate goodwill? Consideration paid plus fair value of net assets acquired, non-controlling interest, less fair value of net assets acquired. That we will calculate from here. We need to calculate retained earning, consolidated retained earning. कैसे? Parent retained earning. We need to add profit share of subsidiary. How much is the profit of subsidiary? We can calculate by comparing both the retained earnings of subsidiary at acquisition and at the time of year end. And if holding is less than 100%, then this will appear as a liability. Otherwise, this will not appear. How to calculate this? Fair value of non-controlling interest that we have used in goodwill plus subsidiary profit share for others. What is other holding? 20%. So this will be calculated. Is that fine?
Oh, yes, sir.
Shall we move forward? Shall we move forward?
Yes, sir. Yes, sir.
Yes. Okay. Now moving towards some other concepts. Can you solve this test your understanding one by yourself?
So as homework or now?
Now give me the answer.
Yes, sir.
So how to calculate goodwill? Consideration paid in amount paid plus fair value of NCI less fair value of
Yeah. s-
net
s-
assets. So what is the consideration paid?
90,
Is that given in the question? How much you have paid?
19.
78,000 we have paid.
uh, fair- Oh, yes, sir.
What is
70,000.
the non-controlling interest fair value?
So it's 19. So
19,000. What is the
97
$85,000 is
and
the
minus
fair
85.
value of
So
net assets? So
12,000.
what?
12,000 is answer.
12,000 is the answer.
Oh, yes, sir.
Simple. Okay, moving on. This illustration is relating to that question we have covered, how to calculate non-controlling interest liability. 12,000 was the fair value and
Yes.
5,000 profit, 20%, 1,000, 13,500 that we just have covered. That was relating to how to calculate group retained earning, parent company retained earning plus profit of subsidiary 5,000, 80%, 4,000, 74,000. Mhm, mhm, mhm. Yeah, focus on this example. What is this? Calculate the fair value of consideration paid. In some time, you need to calculate the fair value of consideration paid by yourself. Where we use it? In calculation of goodwill. Sometimes it's not that much easy. You have paid this amount, simple, but sometimes it's not that much easy. Like illustration 6, Ho acquired a 75% interest in the equity share capital of Spade on 1st January 20x6. So Ho H acquired Spade S, how much? 75%. The consideration consisted of an immediate cash payment of 1.80 per share. Mean the cash will be 1.80 into how many shares you have bought. If subsidiaries number of shares are given in the question, and we have bought 75%, so we can multiply 75% to that, so we can calculate the shares acquired, number of shares acquired, and by multiplying it to 1.80 per price share, we can calculate cash paid. You know,
Oh, yes, sir.
who agreed to issue 2 shares in exchange for every 3 acquired. Not only we are paying cash, we are also giving them our shares 2 for 3. How many shares we have acquired? Against 3 shares, we are also giving them our shares 2 for 3. Each is buying as 75% share capital, and the payment part they will pay in cash, and partially payment they will give as their own shares. Mean through this S will also be owner of it. At the date of acquisition, Spade has 2 million equity shares of $1 value each in issue. How many shares S were having at the time of acquisition? 2 million. How much you have bought? 75%. How much is 75% of 2 million? How much is 75% of 2 million?
Sir, 150.
1.5 million.
Yes, sir.
1.5 million. This means the cash we have paid will be 1.80 per share price into 1.5 million shares. This we have paid cash. The remaining we have issued shares 2 for 3. The remaining we have issued shares. How shares we have issued? 2 for 3. Mean if we have bought 1.5 million against 3 shares, we will give them 2 shares. 2 by 3. How to calculate this? We're gonna discuss. The market value of who share? $1. Fair value is market or fair value is $1. Who shares the first January 20x6 was $3. Its face value is $1, but at the time of acquisition, its market value will be $3. If you are giving shares to subsidiary instead of cash, at what price you will give shares? At 3 mean market value or at par value 1? If you are going to give shares to subsidiary instead of cash, mean partly we have paid cash and the remaining amount we are giving them shares instead of cash. If you are giving your shares, at what value you will give your shares, at a par value or at market value? What is the current value? Market value. So we will give them shares at market value. Mean we will give them shares at 3. Now we need to calculate how much amount the shares we have given to them. The cash we have given to them, number of shares we acquired, 1.5 million. What was the price? 1.80. Whose shares? Subsidiary company shares. Can you calculate this amount? 1.80 into 5 million.
1.80 into
This will be
9.
2.7 million. Now we need to calculate the value of shares. Now we need to calculate the value of shares. How we can calculate value of shares? There is a formula. There is a formula. Number of shares acquired. Number of shares acquired into share given divided by share taken. Into market value or fair value of parent's share. To market value or fair value of parent's share. In this question, how many shares we have acquired? How many shares we have acquired? How many shares we have acquired? If subsidiaries total number of shares are 2 million, so we have acquired its 75% mean 1.5 million. So these shares we have acquired 1.5 million. Into share given, how many shares we are giving them? 2 or 3? 2. Against how many shares we have taken? 3. Mean 2 for 3. And what is the market value of these shares? Can you tell me what is the market value of these share in this question? Are you there?
Oh, sir, actually, I'm figuring because the screen is frozen. Your screen is frozen. Can you refresh?
It's not working. See now.
Um, sir, I can see a still screen only that.
Stills. Let me check. See now.
Oh, yes, sir.
It's working fine.
Oh, yeah. Yes, sir. Yes, sir. Now I can see.
So should I continue from the start?
No, sir, I got the half.
So we need to calculate fair value of consideration paid. Mean how much we have paid either in cash, either in share form. So H acquired 75% interest in S on 1st January. The consideration consists of an immediate cash payment of 1.80 per share acquired. If per share price is 1.8, how we can calculate cash? Per share price multiply by share acquired. How we can calculate share acquired? If we have acquired 75%, what are the total shares of S? And total shares of S
1.5.
are given 2 million. This means out
Yes.
of this 2 million, we have acquired 75%. And what is 75% of this?
1.5 million.
1.5 million. How we calculate it? Into
875 into 2.
75%, so 1.5 million. So 1.80 per share price into 1.5 million. This means this we have paid cash. Remaining, we instead of paying cash, we have given our shares to subsidiary. For remaining amount, instead of paying cash, we have given our share to subsidiary. Either they can keep shares, either they can sell shares. It's up to them. How we have given? Oh, H agreed to issue 2 shares in exchange for every 3 acquired. Mean if we have acquired 3 shares from you, we will give you 2 shares. Mean 2 for 3. How much we have acquired? 150. We will apply 2 for 3. And we are giving instead of cash. This means we need to calculate the amount, how much amount share we have given to the subsidiary. And to calculate that amount, we need parent company share price. And parent company share price at the time of acquisition was 3 in the market. Though its par value is 1, but we will not sell our share at par value. We always sell share at market value. So how to calculate the value of shares? Number of shares acquired into share given 2 by share taken 3 into market value of a parent company shares. What is market value of parent company shares in this question?
So the market value is it's 1.
Then what
It's
is 3?
3. Sorry, it's 3.
3 is a market
3
value
is the
that
market.
is always above than par value.
Yes, sir.
So through this, we can calculate the value of shares. How much is that? 150 into 2 by 3 into 3. So this 3 will be cancelled.
115 to
What will remain? It will be
3
3
and
million.
3 million.
So 3 million we have given shares from working one. We can name it working one. So 3 million we have given them shares. So what is the consideration paid? The total consideration paid will be 5.7 million. This is the way to calculate consideration paid if we are paying some amount in cash and some amount as a share. This is our answer. Copy this answer. And I think we should take a break so that you can absorb these things, and then we will move towards some other concepts relating to consolidation. So coming after a
Oh,
break.
yes, sir.
Until, copy this. Yes, Mr. Sargun, are you there? Are you there?
Oh, yes, sir.
Okay. So we have discussed how to calculate goodwill, how to calculate non-controlling interest as a liability, and how to calculate retained earnings. Now let's discuss one more concept. There was a question. Yes, we got the question. Suppose holding company acquired subsidiary. At acquisition time, suppose subsidiary company was having the asset of 100,000, but that asset market value was 150,000. If holding company, a subsidiary company is having the asset of 100,000, but its market value was 150,000 at the time of acquisition. This means if subsidiary sell that asset, how much profit they can gain? 50,000. How much profit they can gain? 50,000. After acquisition of subsidiary, this profit is also of holding company. Because after acquisition, whatever is the profit of subsidiary, holding company will also be having a right to get that profit according to their percentage of holding. This means this was an asset and this was a fair value of asset. And this was a fair value gain. By calculating net assets, we include share capital, share premium, retained earning. What we would need to do, we need to calculate this fair value gain as well. So share capital was 20,000, 20,000, share premium was 10,000, 10,000, retained earning was 20,000 here, 25,000 here. This 50,000 we will also calculate in net assets. And this 50,000 will also be added in a non-current assets of a holding company plus subsidiary, plus we will add this fair value to prepare consolidated financial statements. Can you understand this concept? If at the acquisition date, subsidiary company, any of the asset of subsidiary company is having any fair value gain. How having fair value gain? Mean its net book value is 100,000 while their market value is 150,000. This means if they sell this asset at 150, they can get a fair value gain of 50,000. If subsidiary company can get this benefit, this means holding company can also get this benefit. So while preparing consolidation, in calculation of net assets, we need to include this fair value gain. And this fair value gain should be added to consolidated assets. How we calculate consolidated asset? Holding company asset plus subsidiary asset, plus we need to add this in the calculation of asset. Let's see this example. Hazelnut acquired 80% of the share capital of Peppermint. Mean H is a parent company and P is a subsidiary, and how much they are acquiring? 80%. This means how much is the non-controlling interest? They are having 20%. On 1st January 2023 for cash consideration of 1 million. This will be used in calculation of goodwill consideration paid. At the date of acquisition, Peppermint had retained earnings of 125,000. This is this retained earning acquisition time. And a revaluation surplus of 10,000. Instead of share premium, they has given the value of revaluation surplus. It will be deal similar like share premium. Like it's the same figure at reporting date, at acquisition date. If this figure is given, this will be same. If this figure is given, this will be same. And this will be used only in calculating net assets. In consolidation, we ignore them because we use only share capital, share premium, revaluation reserve of parent company. At acquisition, the fair value of Peppermint plant exceeding its carrying value by 20,000 or 200,000. In any of the asset of subsidiary, its fair value is exceeding by carrying value by how much amount? 20,000. Yes. By how much amount? 20,000, like we have discussed this example. Fair value gain, how much? 50,000. In this question, the fair value gain is 200,000. What is this? Fair value gain. At the date of acquisition, the fair value of 20% non-controlling interest is 380. Mean fair value of non-controlling interest is 380,000. That will be used in goodwill calculation. That will be used in goodwill calculation. Below are the statement of financial position of Hazelnut. Investment in paper at 100,000, 1 million. That is amount given here as well. 1 million, the consideration paid. So this we need to exclude. Instead of this, we will mention goodwill amount. Property, plant and equipment. We need to add, plus we need to add that 200 fair value gain here. For inventory, we will simply add. For receivable, we will simply add. For cash, we will simply add. For share capital, we will ignore these figures, but these figures will be used to calculate net assets. Retained earning, we need to calculate. And for non-current liabilities, we will simply add. For current liabilities, we will simply add, and we need to calculate non-controlling interest figure here. Calculate the fair value of net assets of Peppermint at the date of acquisition and at the reporting date, but we gonna prepare consolidated financial statements. For consolidated financial statements, we need to calculate goodwill first. For property, plant and equipment, we are having figure 5,500 plus 1,500, 7,200. For inventory, 650. For receivables, 600. For cash, 250. We will add them, and then share capital will be parent company only. For share revaluation surplus will be parent company only, and retained earning we need to calculate, and non-current liabilities we will add them 3,400. Current liabilities we will add them 1,900, and non-controlling interest we need to calculate, and we will be having balance sheet. So we need to calculate three figures: goodwill, retained earnings, and non-controlling interest. So let's calculate. But to calculate goodwill, we need net assets. For net assets, we are having these three figures. So first, we're gonna calculate net assets. So net assets at the date of acquisition and the net assets at the date of reporting. So share capital, we are having revaluation surplus, we are having retained earnings, we are having, and this question we are having fair value of plant. Share capital is 400 and this figure remains same. Revaluation reserve is 100 and this figure will remain the same. Retained earning we are having closing 300. Fair value we know we have calculated 200. What is the retained earning opening? Is that given in the question? Let's see. Papermint retained earning 125,000. At the date of at the time of acquisition, it was 125,000. So we can calculate net assets. 5, 625 and 825. 435 plus 5, 1000. And what is the difference between profit? How much is the difference between profit? 175. Now goodwill. What is the consideration paid? 1 million. What is the non-controlling interest fair value? It's given in the question. How much is that? 380. And what is the fair value of assets? Is 825. Can you calculate goodwill for me? 1380 minus 825.
Sir, it will be 380 plus 175. So
4,
4 50
455.
4 yes. Yes, sir.
455. So we
Yes,
have
sir.
calculated goodwill as 455. Now we need to calculate retained earnings. Parent retained earnings, how much is that? Is 1400. And subsidiary share of profit, how much is the profit? 175. How much is their holding? 80%. What is 80% of 175? What is 80% of 175? 140. How much is that? 1540. So 1540. And now we need to calculate non-controlling interest. So fair value of non-controlling interest is given in the question 380 and subsidiary share of 175, they need 20%. So what will be 35? Altogether will be 5415. Can you check if the total is the same? Tally on both sides. This is coming 9155. 300 plus 200 plus 1540 plus 3400 plus 1900 plus 415 9255. There's a difference of 100. Where that 100 difference is coming. There is a difference of 100 where that 100 difference is coming. Where that 100 difference is coming.
Oh, sir.
Is there any error in calculation? Is there any error in calculation? See that?
600 plus 7200 plus.
Is there any error in calculation? There is a difference of 100 only. Revaluation surplus is 100 at the time of acquisition. Valuation surplus is 100. We have used 100 in calculation or more than this. Valuation surplus is 104 plus 5. This is 1000. That's fine. 1000 paid. Less fair value of assets 825. Retained earning of parent 1400. Yes. 140 is the subsidiary share price. Where is the difference of 100 in my calculation? Can you check whether this total is 9155 or 9255?
Sir,
What is the figure for goodwill is 455? Fine.
455.
1000 plus 380 minus 825 is triple five. Triple five. Now 9255. Tally. Goodwill calculation figure was wrong. So we have discussed how to calculate goodwill, how to calculate retained earnings, how to calculate non-controlling interest, and how to calculate net assets, especially when there is any fair value gain in assets. Let's move forward. Now we are moving towards another concept called intergroup trading. Intergroup trading, what is that? So this is parent company and this is subsidiary. Parent company suppose acquired 80% of subsidiary. What is intergroup trading? If parent company has sold goods to subsidiary, our subsidiary has sold any goods to parent company, that will be called intergroup transactions, intergroup trading. If parent company sell any product to subsidiary, our subsidiary has sold any products to parent company, so that will be called intergroup transactions. Suppose they sold 1000 goods. Suppose parent company sold 1000 goods and that transactions are normally based on credit. This means if parent sold 1000 goods to subsidiary, this means there will be some debtors of 1000 as a debtor in parent company book, and in subsidiary book there will be parent payable, P payable at 1000. What we need to do while preparing consolidated financial statements, we need to eliminate these figures. How we can eliminate our debtor? By crediting debtor. And how we can eliminate payable of subsidiary? by adapting payable. Meanwhile, preparing consolidated financial statements, we need to adjust this entry because the intergroup transaction debtors payables are not from outside, it is within the group, like from one pocket to other pocket. So we need to adjust these payables or receivables that are relating to intergroup. Intergroup mean between parents and subsidiary. In a similar manner, if subsidiary has sold goods to parent company, then in subsidiary group financial statements there will be debtor, and in parent financial statements there will be payables. So we need to eliminate them. How? By adapting payable and crediting debtors, because debtor is asset and asset we can reduce by crediting it, and payable is a liability and liability we can reduce by adapting it. Can you understand this?
Oh, yes, sir.
Okay, now moving towards illustration 8. Statement of financial position of P and S. P is a parent company, S is a subsidiary, non-control current assets, plant and equipment, and this is investment. Instead of this, we will record goodwill. Current assets, inventory, we will add, receivable, we will add, bank, we will add. Equity, share capital, we will use only this figure, and retain earning, we need to calculate. For non-current liabilities, we will add, current liabilities, we will add. P acquired 75% of S on 1st July 20x5 when the balance on S retained earning was 1150. Mean this is the retained earning opening balance, retained earning balance at the date of acquisition of subsidiary that we used in calculation of net assets. P paid 3500 investment in shares in S, mean consideration paid. At the reporting date, P recorded a payable of to S 400. Mean parent company books is having payables of 400, like a subsidiary has sold goods to parent company. And this agree to the corresponding amounts in S financial statements. Obviously, there will be receivables. So what we need to do, how we can adjust these figures. So at the date of acquisition, it was determined that S land carried at cost of 2500 had a fair value of 3750. Mean there is a 1250 fair value gain. At the date S plant was determined to have a fair value of 500. In excess of carrying amount, the fair value had not been recorded by S. Mean this is revaluation surplus. The P groups uses the fair value method to value non-controlling interest. This is the fair value of non-controlling interest. What you need to do, calculate the consolidated receivables and payables. Consolidated receivables and payables mean this 400 has been recorded as payable in parent and receivables in subsidiaries. What we need to do, we need to eliminate this from consolidated, mean this is the holding company receivable, this is subsidiary receivable, so we need to eliminate this 400. These are the payable of holding company, these are the payable of subsidiary, and we need to eliminate, mean these are the consolidated receivables and payables figures. Meanwhile, preparing consolidation, non-current assets will be added, plus we need to add the fair value gain given in the question. Plant added. Instead of this, we will record goodwill. We need to calculate. Inventory will be added, but receivables we need to subtract 400. In similar manner, from payable under current liabilities, we need to subtract 400. The remaining thing we have already discussed how to calculate. Now moving forward, one more concept relating to intergroup transactions. So this is parent company and this is subsidiary. Suppose parent company sold goods of $1,000 to subsidiary. Normally, when we sell the goods, we record the sale at the sale price. And in sale price, there is a cost as well as a profit, both things included. Not only we need to adjust receivable payables relating to intergroup transactions, we need to adjust this profit part as well. Suppose the sale is 1,000. The cost is say 800 and 200 profit. If P sold goods to subsidiary and made a profit of 200, what we need to do, we need to adjust this profit in consolidation. Why? Because this profit is not realized. It's like you have put goods from one pocket to another pocket. If we sell goods outside the group, then that profit will be realized. We will record profit. If any transaction made within the group and there is any profit amount involved, that profit will be called unrealized profit. Unrealized profit. In this profit is not generated. It's like we have put goods from one pocket to another pocket. So what we need to do, we need to eliminate this profit from the group. How we can eliminate this profit from the group? Debit retained earning, credit inventory, because this profit is included in the inventory because S has purchased the inventory. So they recorded purchases as inventory in the balance sheet. So inventory is asset. We need to deduct that profit part from the inventory. So we will credit the inventory by 200. And we need to debit the retained earning because the profit is included in retained earnings. So by debiting retained earning liability, equity, we can eliminate this effect. In case of intergroup transactions, we need to adjust the receivables payables and we need to eliminate the part of profit because that profit is unrealized profit. How we can eliminate? Debit retained earning, credit inventory. Can you understand this?
Oh, yes, sir.
In similar manner, if suppose subsidiary sold goods to parent company, this means the profit is recorded in subsidiary group. How we can eliminate? Same transaction, retained earning debit and inventory credit. Because inventory is available in the group either in subsidiary or parent, and we add both inventory. So we need to deduct these 200 from both inventories. And while calculating retained earning of parent company plus subsidiary shares, we need to deduct this amount to 200 as well. Is that fine? If inventory
Oh,
figure
yes,
is a
sir.
separate available in balance sheet, we will deduct 200 from inventory. If current assets figure available, so we will add both current assets and we will subtract 200 from current assets because inventory is included in current assets. Can you understand this concept?
Oh, yes, sir.
In case there are intergroup transactions, there is any profit part that we need to eliminate. How we can eliminate that profit part included in intergroup transactions? By passing an entry, but we need to calculate that profit first. Now suppose there was intergroup transactions of 1,000. Out of this 1050% sold outside group. Means subsidiary out of that 1000 inventory sold half of the inventory to outsiders. So that half profit has been realized because that made from outside the group. The remaining half we need to pass the inventory 100 because half has been realized. So what gives a half? 100 is unrealized that we need to pass the inventory. At that 100 we will deduct from inventory and from retained earnings. Can you understand this? So what is the standard saying? If there are any intergroup transactions, we need to eliminate unrealized profit part from unsold inventory, because out of 1000 half have been sold outside the group, so remaining half left. So what is the profit part in that half? That will be half of this profit, that is 100. Suppose 75% of inventory has been sold outside the group. If there was intergroup transaction of 1000, but 75,000 has been sold outside the group. How much inventory remaining? 25%. This means we need to eliminate profit of how much? 25% of 200, and that will be what? 50. So we need to record this entry by 50. So we need to make sure how much inventory relating to intergroup transactions is unsold at the year end. And we need to eliminate profit part relating to that unsold inventory only. Means 75% sold, so 25% is unsold. Can you understand this concept?
Oh, yes, sir.
I'm explaining again. If parent company sold 1000 goods to subsidiary company, and in that 1000 the cost is say 700 and profit is say 300. This profit is unrealized, that should be eliminated at the time of consolidation. How profit can be eliminated? Debit retained earning. I mean, retained earning is an equity having credit nature. How we can eliminate or reduce any equity by debiting it. And this is included in inventory of subsidiary. So we need to exclude from inventory. Inventory is asset having a debit nature. How we can reduce any asset? By crediting it. So this accounting entry should be passed. But we need to make sure whether these all inventory that the subsidiary has bought from parent company is still remain within the group, or some part of it sold outside. If the complete 1000 sold outside, then this complete 300 is realized. We don't need to pass this in entry because this 300 has been realized because we have sold the inventory to outside the group. That is not remaining in the group. This means we don't need to pass this in entry. This 300 is realized profit. If half of this has been sold outside the group, half still remaining within the group in a subsidiary financial statement, then this means with the half amount we need to eliminate the profit. If 75% of this 1000 inventory has been sold outside the group, 75% is 750. This means only 250 inventory left. This means this profit 375% is realized, only 25% unrealized. So what is 25% of 300 is a 75. We need to pass this entry by 75. How to calculate 75? 300 into 25%, that is unrealized. Can you understand this concept? If
Oh,
you
yes, sir.
understood, then I am moving towards making this more complex. Can I make it more complex?
Oh, yes, sir.
Now see, parent company, subsidiary. If parent company sold inventory to subsidiary, parent company sold inventory to subsidiary, and their holding is 80%. Their holding is 80%. Sell 1000 of inventory. We will see how much inventory is left at the year end. We will pass this transaction with the unsold inventory profit part. Either holding is 80%, either how much is the holding, doesn't matter. Now, if parent company has bought goods from subsidiary, holding is 80%, and they have bought goods of 1000, and in 1000 say 800 is cost and 200 is profit. We need to pass entry of unrealized profit. Suppose nothing is sold outsold, still that inventory remains within the group. This means we need to pass an entry debit retained earning, credit inventory with amount of unrealized profit. What is the amount of unrealized profit? 200. We will credit inventory by 200. But out of this 200, how much is the part of parent company? 80%. So we will debit retained earning 200 with 80%. That is 160. Remaining part is relating to non-controlling interest. So we will debit non-controlling interest 200 into 20%. How much will be that? 40. I mean, in case parent sold goods to subsidiary, we will pass this entry debit retained earning credit inventory. But in case subsidiary sold goods to parent company, then profit is recorded in subsidiary's financial statement. So we will eliminate only that part of profit that is relating to group. The remaining part is relating to non-controlling interest. So we'll credit the inventory by complete profit, unrealized profit. But retained earning we will debit by parent company share, and remaining part we will debit non-controlling share. If parent company sold the goods to subsidiary, profit is included in parent company, and parent all profit is there. So we will record this entry. There will be no non-controlling interest because profit where it is recorded in parent company. But if subsidiary sold goods to parent company, then profit is recorded in subsidiary, and subsidiary all profit is not relating to parent company. If holding is less than 100%, some part is relating to non-controlling interest as well. So in that case, we will credit inventory by complete amount. And retained earning will be debited relating to group mean parent company shares, and remaining will be relating to non-controlling interest shares. So while preparing retained earning, how we prepare retained earning? Parents retained earning plus a subsidiary shares less is unrealized profit. While preparing calculation for non-controlling interest, how we calculate fair value that is given in the question plus subsidiary share less what we call it unrealized profit. And this inventory will be deducted from inventory or current assets while adding them for consolidation purposes. And these two things will be used here while calculating retained earning and non-controlling interest figures. Can you understand this concept? I mean, when we need to incorporate non-controlling interest in unrealized profit accounting entry, when subsidiary sold goods to parent company. If parent sold goods to subsidiary, we don't need to incorporate non-controlling interest because the profit is available in parent company. In parent company, there is no relation of non-controlling interest. If profit is calculated in subsidiary because subsidiary sold the goods, this means profit is there. So that profit is not all relating to parent company, only share of parent company is relating to that. The remaining part is relating to non-controlling interest. Non-controlling interest mean other investors. Let's have a question. Let's have a question. Yes. H acquired 90% of equity shares of S. This means non-controlling interest is how much? 10%. On 1st
10%.
January, when the retained earning of S were 5,000, in this is subsidiaries retained earning at the time of acquisition. Statement of financial position as at 31st December are this. This is holding company, this is subsidiary. So property, plant and equipment, we will just add investment as instead of this, we will record goodwill. Inventory, we will add receivable, we will add bank, we will add. From retained earnings, we will use only share capital of this. For retained earning, we will calculate this figure. And for non-current liabilities, we will add current liabilities, we will add, and we need to calculate non-controlling interest as well. S sold goods to H. Who is S? Subsidiary or parent company? Subsidiary. So subsidiary sold goods to parent company at a transfer price of 18,000. Mean this is the selling price. And in this sale is equal to what? Cost plus profit. What is the sale? 18,000. Including a markup of 50%. Markup is on cost or sales. Markup is on cost or sale. We have discussed in previous class. Markup on cost. Markup on cost in it. This means this is 100, this is a 50%, and this is 150%. And if we are having sale figure, can we calculate cost and profit? Because if 18,000 it itself is 150%, so we can move towards profit 50%. How much is the profit figure? 6,000.
12 and 6.
This means cost is 12,000 and profit is 6,000.
6 remaining.
So this is profit relating to intergroup transaction. We need to know whether any inventory sold outside the group or still remains. 2/3 of those goods remained in the inventory at the year end. What is 2/3? 4,000. This is unrealized profit. Because 1/3 sold, this means 2/3 still remains in the inventory at the year end out of this. So what is the unrealized profit? 4,000. How much is our share? 90%. How much is non-controlling interest share? 10,000. What accounting entry we will pass for this? Debit, retained earning. How much? 4,000 into 90%. What is 3,600? Debit, non-controlling interest. 4,000 into 10%. What will be that? 400. And credit we will make inventory. How much? 4,000. So this will be the accounting entry we will record at consolidation. The current account in H&S stood at 22,000 on that date. What is current account? Current account is relating to debtors and payables, mean receivables and payables. That we need to deduct from receivables and payables, mean from here we will deduct 22 and from current liabilities we will deduct 22. And that 4,000 will be deducted from inventory. Can you understand this? Current account mean relating to receivables and payables. The H group uses the fair value method to value non-controlling interest. The fair value of non-controlling interest at that date is 4,000. So he has given calculation, I mean how profit has been calculated. Calculate the unrealized profit adjustment required. So we have calculated unrealized profit adjustment required. Is that fine? Is that
Oh,
fine?
yes, sir.
Do we need to prepare consolidated financial statements for this, or we can prepare? Goodwill we can calculate. This is the consideration paid. Fair value of net assets required. We will calculate by using these figures. Retained earnings at opening is given 5,000 at the time of acquisition. So retained earning we can calculate, non-controlling interest we can calculate, and goodwill we can calculate. Is that fine?
Oh, yes, sir.
Okay, now moving towards the last concept of this chapter. That is mid-year acquisition. Mid-year acquisition. What is this mid-year acquisition? Suppose this is the year end, 1st January 2023 till 31st December 2023. If the acquisition is made on this date, then the profit, suppose the profit calculated through net assets is 10,000 and 80% is holding, then 80% will be included in retained earning, in subsidiary profit share. While calculating consolidated retained earning, how we calculate? Parent company retained earning plus subsidiary shares. Mean if the profit is 10,000, we will calculate 80%. If suppose acquisition is made during the year mean when it is made, suppose it is made on 1st of April. Then we will not include the complete 8,000 profit. We will charge only for the part of acquisition because this profit was before acquisition. We can consolidate from this date till this date, mean from 1st April onward. If we calculate there are 9 months, this means we need to multiply by 9 by 12, and by multiplying 9 by 12, suppose it comes 7200. So we will calculate here 7200 rather than complete 8000. Mean if acquisition made at start of year, then while calculating retained earning, how we calculate parent retained earning plus subsidiary share of profit. If the acquisition is during the year, then we need to multiply number of months on a subsidiary share of profit, and then we will calculate retained earnings. Can you understand this?
Oh, yes, sir.
If acquisition made during the year. See this question. On 1st May 2007, K acquired 60% of S. K parent company as subsidiary, paying 76,000 cash. This is cash consideration. The summarized statement of financial position of two entities at 31st November 2007 were: year end is 31st November. When you bought S on 1st May, how many months in the current year should be consolidated? May, June, July, August, September, October, November. 1, 2, 3, 4, 5, 6, 7. 7 by 12. And consideration paid is 76,000. Property, plant and equipment, we will add both. Instead of investment, what is this investment? He said consideration paid is 76,000. Why he is saying investment is 98,000? This means this investment include amount paid to subsidiary as well as some other investment. What could be the other investment of 2,200? So in consolidation, what we use PPE, we will add both. We will record goodwill that we will calculate, and other investment we will record as investment of 2,200. Because this investment 9,800 is not relating to all consideration paid. This include amount paid to acquire subsidiary of 76,000 and some other investment in any other company or any other where. So that other investment we will record separately. Goodwill we will calculate for the 76,000 part, we will calculate goodwill. Can you understand this? Inventory we will add, receivable we will add, cash we will add. For equity, we will record only this. Retained earning we need to calculate. These figure will be used for calculation of net assets. Current liabilities we will add. The following information is relevant at 30th November year end. The inventory of S included goods purchased at cost of 8,000 from K. Who sold to whom? Parent sold to subsidiary or subsidiary sold to parent?
Subs
Subsidiary sold to parent or parent sold to subsidiary?
the subsidy.
The inventory of S included goods. Who bought is holding the inventory.
So as
S bought,
S
this
bought.
means this transaction is between parent to subsidiary. This means we
S
need to
bought
record
goods from
retained
K.
earning debit and inventory credit. There is no need to record non-controlling interest because the profit part is included in parent company. Purchase at a cost of 8,000 from K, cost plus 25%. What is the 25%? 2,000. This means selling price will be 10,000 and 2,000 is the profit part. None of the goods had been sold by S by the reporting date. This means with complete 2,000, you need to record this entry. And this 2,000 will be eliminated from this inventory. Where is inventory? And this 2,000, while calculating retained earning, we need to subtract. The K group value for non-controlling interest using the fair value method. The date of acquisition at fair value 40% of non-controlling interest. This is non-controlling interest that will be used for calculation of goodwill as well as non-controlling interest figure. Has earned a profit after tax for the year 9,000. This is a retained earning of S in the year ended 30th November 20x7. Mean there is no retained earning at the date of acquisition. He said 9,000 is profit. This means if a reporting date is 69,000, then what could be at the acquisition date retained earning for subsidiary? That would be 60,000. Calculate group retained earning of K groups at 30th November 20x7. If we move towards preparing consolidation statement, first we need to calculate net assets. So net assets at the date of acquisition, net assets at the date of reporting. And we know there are two figures only available, share capital and retained earnings. Share capital is given how much? 40,000. That will remain same on both date. And retained earning reporting date given 69,000. And he said they made profit of 9,000 during the year. If they made profit of 9,000 during the year, if they made profit of 9,000 during the year, then this will be 60,000 because the difference between them is 9,000. So 100,000 is the fair value of net assets required, while reporting date is showing 109,000. So we can calculate goodwill. What is the consideration paid? That was 78,000 or 76,000? 76,000. Non-controlling interest figure is given in the question. How much is that? 50,000. $76,000, 50,000, and 100,000 is the net assets. So 76 plus 50, how much is that? 126. So 26,000 is the goodwill. Now we need to calculate retained earnings. Parent retained earnings figure is 189,000. And subsidiary share of profit 9,000 is the profit and 60% is a holding. How much of 9,000? 60%, 5,400. And we need to eliminate this 2,000 from the retained earning. So what is this? Unrealized profit. How much? 2,000. What's the total? 189 plus 3,400. 192,400. And we need to calculate what the non-controlling interest. So fair value is given in question 50,000. And what else? Subsidiary share 9,000 into 40%. 3,600. So this will become 5,3,600. Is that
Oh, yes, sir.
Now, if we move there, what is goodwill figure? Goodwill is 26,000. 138 plus 115.
138 plus 115 will be, sir, 150.
3, 4,
53.
5, 253.
Oh, sorry, 253. Yes, sir.
And by excluding 2000 from inventory, 15 plus 17, it's 22, 32. 32 minus 2, it will be 30,000. And 39,000. 2,000. So make it total. And for equity, we are having a 50,000. We are having 192,400. We are having non-controlling interest of 53,600. And we are having 33 plus this 43, 76,000. So can you check the total for both sides? Is it agree? I hope this will agree. And this chapter has ended now. There is nothing left in this chapter. Completed. So what we have learned few concepts how to calculate net assets by using subsidiaries reporting date figures. How to calculate goodwill, consideration paid plus fair value of non-controlling interest minus fair value of net assets acquired, this figure. How to calculate retained earning for consolidation purpose, parent company retained earning plus subsidiary share of profit and minus unrealized profit relating to intergroup transactions. And then we need to calculate non-controlling interest. Fair value of non-controlling interest plus subsidiary profit share less unrealized profit if subsidiary sold the goods to parent company. In that question, parent sold the goods to subsidiary. That's why we didn't incorporate the non-controlling interest figure relating to unrealized profit. That's it. We'll see you next class. In next class, we will cover.
Sir, when is the next class?
Next class will be on in January.
Okay.
Next class will be in January
Yes, sir.
because I'm also going on holidays.
Oh, yes, sir.
So next class we will conduct in January. Until then, try to cover the previous things.